Shares of Fiverr are trading at $26.02, and they are up around 20% over this past 6 months. And zooming out on the chart, we can see that the stock has had quite the run since its IPO 5 years ago. But the question is after being stagnant since mid-2022, are we going to see the highs that we saw in late 2020? Well, personally, I love stocks like this that have run up and then crashed and then been stagnant because it shows an opportunity. It shows you how high it can potentially go. Anyways, for my December 2026 price projection, their earnings per share is expected to rise 129% to $1.19, and their current PE is 84, but that is so high that I'm going to use 30 for 2026 because I see a lot of competitors around the 25 mark right now. So if we multiply 30 by that $1.19 EPS, then that gives us a share price of $35.70, which is a 37% upside. Other analysts are predicting bullish results as well. They're looking at $30.50 for 1 year from now, and that's about 17% higher than where it trades today, with a high estimate of 36 and a low of 25. Going into our triangle analysis, for growth expectations, it looks like Fiverr has beat all 4 of their last earnings calls, and in terms of revenue and net income, the revenue does look really good and has been pretty solid, and their net income has been trending up recently as well, which is great to see. And for their internal metrics, spend per buyer is rising steadily, and their net profit margin is back in the positives, which is great to see. With nearly every metric improving, I'd put their growth expectations at a 4 to 5 because it's clear that they're really starting to gain momentum in the right direction. And moving on to valuation, obviously their price to earnings is really, really high at 84, but that's just a sign that investors have already priced in a lot of that expected growth. I mean, 129% from now till December 2026 is a lot of growth. And so it's clear that's been priced in. The risk of that happening is really negated by their earnings growth. I mean, 129% from now until then really makes up for any decline in valuation. So for that reason, I would have to put their valuation at 3 to 5 because it could be better. But again, because those earnings are expected to be so good, it really makes up for a lot of that valuation risk. For health metrics, they do not offer a dividend, but what's interesting is they did announce $100 million worth of share buybacks potentially for 2024, and that would actually decrease the amount of shares outstanding by 10%. Fiverr also has a shareholder equity of $321 million and a total debt of $456, making their debt to equity pretty high at 142%, but they do have a really, really nice free cash flow of $92 million. And they are also sitting on $270 million worth of cash equivalents, which I suppose is there mostly to back up their potential $100 million share purchase. And so even though their debt to equity is high, honestly, I would put their health metrics at a 4 because, like I said, even though the debt to equity is high, just because they have so much cash flow and so much cash they're sitting on right now, I mean, it really makes up for all matter of sins. Free cash flow really, really does. So in conclusion, despite the really high valuation and the fact that my projections aren't as high as other analysts state, I really like Fiverr, and I think it's an easy buy just because of its impressive earnings expectations, the free cash flow, the large cash reserves, which are incredibly, incredibly reassuring, especially when you combine those health metrics with their internal metrics starting to trend in the right direction, starting to build momentum. It's really great to see. So for that, Fiverr is an easy buy. So anyways, that's all I have for you today on Fiverr. Please drop a like. Let me know which stocks you'd like me to cover next. Go to thesavvyanalyst.com. Take my foundational stock trading and analysis course. It's completely free. You don't have to sign up for anything. You can just go when it's there. And I'll see you next video.